Now I'm going to draw a very interesting story for you. Okay? There's a gentleman whose name is Raj. नाम तो सुना ही होगा. Okay. So Raj thinks that he needs to start a business now. So he sets up a business called as ABC Corporation. And let's say this ABC Corporation is into, let's say, fast fashion. Plans to compete with Zudio for that matter. Okay. So we have Mr. Raj who has just started a new business, or rather he has an idea to start a new business, and that too into fast fashion segment. So right now he just has an idea. Okay. So what he does is he goes to an investor. This investor's name is called as Mr. Angel. The context is Mr. Angel knows Raj very well. Mr. Angel thinks that Raj is a very good entrepreneur. He will make good profit, whatever the idea be. Raj will definitely make good profit out of it, and Mr. Angel will enjoy good returns out of it. So he gives Raj a check of few $1,000s, 10,000, 15,000, whatever. This kind of funding is called as angel funding, where you just have an idea of the business. The investor's focus is a bit less on the idea, but more on the entrepreneur and his capacity, and is ready to write checks, investments for that entrepreneur. Okay. After this, Raj is happy. What Raj does is Raj goes ahead and comes up with something called as MVP. MVP stands for minimal viable product. This is nothing but, think of it in this way. Okay? Think that you yourself are Raj. You have started a fast fashion business. The first thing you want to showcase is the quality of clothes you have. Secondly, your fashion sense, how it resonates with, let's say, millennials or Gen Z, Gen Alpha. Sorry, I don't know all the relevant segments, but just to show your styling sense, your quality of product, and how you are ready to present your products, you came up with a demo piece of, let's say, a jeans and a jacket. This is nothing but your MVP, minimal viable product. You present it to your next set of investors again. I'm not naming them. Let's say it's a small group. You present this jeans and jacket to them. They are happy by looking at the product quality and the fashion sense you have. And these guys also write you a check. And this is nothing but seed funding. Then the word itself has the meaning, what they're trying to say. Think of angel in such a way that someone who has as big as angel, demon, god, vagara. In that context, someone is stepping in and giving you money. So that is angel investing. When we talk about seed funding, think of it in this way: for a tree to grow big, you need to start with a sapling, or even before that, you need to start with a seed that is being grown into the into soil. So that level of funding, that seed or soil में डालने के लिए, what you need is nothing but your seed funding. Okay. Next part. After you have built your MVP, next what you do is you want to set up one store, let's say in Mumbai for that matter. So you need few crores. Plus you also want to reach out to some vendors, rather suppliers, who will give you raw material or at least do the production for you, so that you can stack up some inventory as well. Inventory is nothing but, you get the stock which you want to sell ahead, but instead of selling, you keep it in storage. Your reserve stock, that is your inventory. So to do all this, definitely you need few crores. And for that, again, you approach new set of investors, which are called as venture capitalists. Most of the time, the seed funding guys and venture capitalists overlap, because over here you will see that building MVP is not an easy task. You need money to do that. And again, further, building stores, building your small presence, proving yourself in a small market also need considerable amount of money. And again, you need investors for that. So venture capitalists are the one who will be funding you throughout this process of building MVP, and then again setting up your business at a small level. Okay. Now, assume this, that it has been 1 year. Raj has successfully proven himself in the Mumbai market. And now Raj wants to grow his business pan India. So he wants to take his business right to Delhi, Pune, Bangalore, Chennai, Hyderabad, uh, Kochi, exciting market. Then we have, I think, pretty much covered all major cities, Kolkata, and etc. Other cities as well. So for that, now Raj thinks that I need huge check as big as, let's say, 80 to 100 crore. So he reaches out to a firm which is called private equity. Private equity are funding investors, are investors, but it's just that their ticket size, the deals they do, the money they hand over is huge in amount. So these guys also kind of get funding. Let's say these guys hand over a check of 100 crores to Raj, and now Raj is happy. Raj has started setting up different stores throughout the country, and now he's happy with the business he's doing. Let's say after 2 to 3 years now, let's say overall 5 years are done. His business is big enough. Now there are two things in his mind. First is whichever investors that have helped him right from the beginning. First, we had angel guys, then we had seed funding done by venture capital guys. After that, he had private equity guys help him. In these three phases, whoever has invested money, he wants to give their money back with some return. Plus, he wants to grow this business further to penetrate even smaller cities. Let's say he wants to enter markets like Madhya Pradesh, Shillong, Goa, all other, let's say, tier 2, tier 3, tier 4, all the cities. So he needs more capital for that, an intense capital for that, an intensive, huge capital for that. So instead of again going back to some other set of private equity investors, another thing what Raj thinks of is, let's go to public and ask for investment from them. So whenever you see, company coming up with an IPO, which is initial public offering, it is nothing but an entrepreneur coming directly to the public saying that this is my business. I think this is good enough. Can you give me some money so that I can even grow my business further and pay you back good returns. Okay. Now, most fundamental question, that why is Raj getting so much money? Wherever he is going, people are just handing him the check. So it comes at a cost. That is nothing but equity. What is equity? The word the word equi means equal rights or equal ownership, but keep that context aside. That context, I think, has expired in today's date. There are two things which you need to focus on. Equity is a security. Security matlab just a simple contract. Okay. It's a security which gives you two things. Okay. One is the ownership, and second is voting rights. We won't go into details of how voting rights work and all right now, even how ownership works and all, but try to understand the context at a very macro level. Okay. Whenever Raj went to his first set of investors, which were angel, Raj said that I will give you 5% ownership of my business. So after 5 years, 10 years, whatever will be the value of my business, you will always own 5% of that. That's the ownership part. Second part is voting right. Voting right means whenever I'll be taking critical decisions, you will have a say in it. You will get to vote in our meeting room. Okay. Right now, I am not going to spend much time on voting rights because it's a huge topic. We'll discuss it separately when time comes. Right now, our objective is to just have basic understanding of what is equity. Okay. So moving on, when he went ahead to the VC funding guys, maybe he offered 8% of his ownership and said, whenever my, let's say, business value increases, you will always get 8% of it. After that, he went to PE guys. Maybe he diluted 12% of his business. So when he was going for public offering, initial public offering, IPO, that is going to the public and asking for money as capital, he was not 100% owner of this business. These investors owned, say, 12, 8, 20, 25. The investors owned 25% of the business. Raj owned 75% of the business. And even while offering the investment to public, not necessary, he will offer the whole 75%. He will maybe go up to additional 20% sold off to public, which will make sure that he still owns after selling off 20% from the 75, he still owns 55% of the business. This is how the whole funding, diluting your ownership and other part works. Probably you must have seen this part in Shark Tank, where people come up with their MVP. MVP is the demo product on the show. And maybe business started to some extent, not huge setup, but to a smaller extent. They will come and they will dilute somewhere between, let's say, 5% and 20%. That's the ideal dilution that should happen. Anything beyond 20% being diluted at this early stage, very risky for your own intentions in terms of having interest in the business. But having said that, I hope this gives you an overall idea that what is equity. Equity mainly covers two things: ownership, voting rights. We'll discuss voting rights separately. In terms of ownership, how much percentage ownership are you diluting? That matters a lot.